All right, so now we're going to talk about the banking institution in the United States. So, first thing first, this is more about how the individual interacts with the banking system and the financial institutions within the United States. This is not how other countries operate. So, if I mention any specific laws related to banking, they are U.S. specific. All right, so first things first, when we're talking about banks, we're talking about financial institutions. That's what a banking system is in a very broad sense. All right, the main purpose is they bring savers and borrowers together. So people who want to save money, they keep their money someplace safe, like a bank. You used to keep it in like a mattress or in a safe. Very famously, if you look at a Wells Fargo emblem or a logo, you're going to see a coach. Well, that coach used to go all around the country with ironclad boxes full of gold that was in the bank's possession. That was the investment of savers. That same money would be lent out to borrowers at interest. That's how banks made their money. And the Wells Fargo coach was also very famous for the coach gun, which is a very short-barreled shotgun that was used to defend the coach as it was traveling across the country. All the money that's deposited in these institutions is then loaned out to other people who need funds, who want to borrow money for a business or for a mortgage or for an auto loan. They all get that money gets loaned back out at a certain percent of interest. The financial institutions cover their operating costs and earn a profit from that interest they pay on their loan, and they usually give back a small percentage of what they make back to the investor, or in this case, the person with the money in savings. So if you put money into a bank, that bank then lends out your money at a high interest rate. They then pay you back for that service with a small percentage of that interest. All right, there's three main types of financial institutions in this country, two of which are still common, one of which has basically all but gone the way of the dodo. The first one is commercial banks. These are probably the most common. These are like BB&T, Wells Fargo, RBC Bank, all the major banks you see on commercials with various financial institutions. They are for-profit, and they offer full-service banking. So they'll give small business loans, they'll give home loans, they'll loan out money to anybody, and they do things like credit cards sometimes, like Bank of America does credit cards. You'll also have various other debit, checking account, all these other various services banks will have. Savings and loan associations. These have all but gone away. There's been so many banking regulations that's just changed the market in such a way that savings and loans don't really exist in any real aspect. A lot of local banks still say savings and loan on them, but really they're just a small commercial bank at this point. Savings and loans used to not have the same kind of regulations that normal banks had. Savings and loans were literally owned, and the people in charge were hired by the owners. The owners would be people in the bank. So if you had $1 million in the bank, and that was more than half of the actual value of the bank's capital. So let's say let's say you had $1.5 million, and you put that all into a savings and loan, and the savings and loan's whole balance sheet was $2 million. That means that you have 3/4 of all the ownership of that savings and loan association. So you could decide who was in charge of making major decisions, and because of that, they got pretty well known for predatory lending related to mortgages. But early on in their history, the purpose was that it would allow people who were members of the Savings and Loan Association to take out mortgages to buy houses. The most famous example of this would be the movie It's a Wonderful Life, where the main character there is starting up his own small savings and loan company to basically help small-scale farmers and owners in a small town be able to afford mortgages to buy houses. Credit unions are the next kind of banking institution. This is another very common one. So again, commercial banks, most common, savings and loan, pretty much almost extinct at this point, and then you got credit unions. Credit unions are owned by their members much like a savings and loan, but the control of them is still by a board of directors. The largest one in this state is State Employees Credit Union. If you're a state employee, you have access to the State Employees Credit Union. Now, what they don't do is give full banking services. There is no State Employees Union credit card. The State Employees Credit Union does not give out loans for businesses. That you have to go to a commercial bank to do that. They don't take really high-level risk loans. So if you're buying a house and you want to get a mortgage to the credit union, it's awesome. You get better fees, lower interest rates. They're more friendly to you. But the other flaw to that is the house still has to be worth what you're taking the loan money out for. Otherwise, they won't lend that money to you. But the biggest benefit of the credit unions is lower fees, lower interest rates, and they pay back at a higher interest rate. So if you have money in the credit union, that money gets paid back at a higher interest rate than it would, let's say, at a commercial bank, which will pay you like far less than 1%. You'll get closer to 1% at the credit union. All right, banking services, and this is just a long, long list of all the various services banks do for us. All right, first things first. It's a place to save and store your money safely. So think about what life was like before banks. Where would you keep your money? In the mattress, under the house. You might keep it at a friend's house or at a business, someplace that you thought was safe. Think like the Wild Wild West. If you were to have your money shipped across the country, it could be prone to thievery. It could be prone to somebody, what's the word I'm looking for? Embezzling the money, stealing it from the company itself. You could lose that money. Banks were a safe way to keep your money away from you so it wouldn't be stolen, robbed, or lost in a fire, and in a safe environment where you wouldn't lose that money. It makes it so purchases are more convenient. So think about debit card. Ways to make purchases nowadays. Even before debit cards, what we do, we used to write checks all the time. Checks are written not because they're actually valuable by themselves, but basically it's a check out of a checking account that will allow you to write that check and get the information, get the money to the person, although it's not technically really money. It's a check representing the value of money out of the account. It's a way to have a checkbook that's basically worthless unless it's got your signature on it, without having the risk of having the money on you. So it's a way to have access to your money without the exposure of having your money on you. And early on, checks were a great way to make it so there was no reason to rob somebody going from place to place, because if they have checks on them, well, the checks are kind of useless. Because especially thinking back to the Old West days, if you're in a small town and you start writing checks out of somebody else's checkbook, people are going to know because they know whose checks those actually are. But nowadays, there's check fraud and everything else. So checks aren't quite as good as they used to be. But now we have the debit system with PIN cards and PIN codes, and the ID being on the picture ID being on the card. So it's much more less prone to thievery and ID theft. Banks give you the ability to borrow and repay money in the future. So basically, you can borrow a large sum of money now, $100,000 now, and over the life of the loan, you'll pay $150,000, but at least you got access to that first loan to buy the house. The other option would have been to save until you have the full amount of whatever you're trying to purchase, which takes a long time, and you might never get to that full amount of money. Things get in the way. It's a lot easier to make that $600 a month payment than it is to suddenly just have $100,000 in your pocket. It's a lot harder. More banking services, checking accounts. So checking accounts, obviously that's where you write checks out of. Now we call them debit accounts sometimes because we use those terms synonymously, checking and debit accounts. It's a way to make purchases without cash, which tend to be safer purchases. Debit cards, they automatically withdraw money from a checking account. So a debit card is basically a swiping version of a check. So most of y'all in the year 2017, if you're in 10th grade listening to this video, you will probably never have to write a check except for your first and last month's rent when you're renting an apartment, or for other various random things you might do for applying for schools or doing other very strange individual things. Like the only time I ever use my checks is when I have to, one, set up a direct deposit account if I get a new job somewhere, or on the very rare occasion I have to pay a tax or something like a sales tax. If you run a business, you might have to pay by check. It's very uncommon to just be forced into using checks now because it's safer to go online and do it. It's more convenient. All right, ATMs, automatic teller machines. So basically that's what it stands for. You can withdraw, deposit, and transfer funds 24 hours a day, and usually those funds are deposited within 24 to 48 hours. Online banking, this is the new thing. We see more and more of this. Now there's smartphone banking. I can just take a picture, like Bank of America has a cool app. You just take a picture of the check, take a picture of the back with your signature on it, and boom, it deposits, and you're done. Very, very, very simple. So the wave of how banking has changed in the last 15 to 20 years is really kind of astounding. So I kind of grew up with, my parents all wrote checks. And then you started seeing these cards come around, and now you're starting to see phones do things. So like iPhones and Androids, they now come hooked up to where you can keep your debit and credit card information on and just hold it up to the little kiosk at the store, and boom, you're done. Now that also might expose you to someone stealing your phone and having access to all your credit cards, but it's a convenience versus risk kind of balance there. Savings accounts. All right, savings accounts are by far the most common early account people get. Most young people get a savings account early on in their life as a way to just kind of explain and show how you should start saving. Now, the benefit to a savings account, you can take the money out at any time you want, and there's no penalty. But you'll only earn a small amount of interest on that money. So I deposit $1,000 into it. In a year, if I don't touch that money, I might have $1,001. So I might make $1 off of it. But at the same time, I don't have to keep that money in there. I can take it out, remove it in and out as much as I want to. Same thing with this checking account. Now, a certificate of deposit, often called a CD, it pays out a much higher interest rate, but the funds have to be kept there for a specific period of time. If you withdraw them early, you get penalized. So you might lose a bunch of the interest you collect. So let's say you have a 1-year CD. If you take it out in 6 months, you might lose most of the interest you've collected in that 6 months. If you keep it the whole year, you get to keep all the interest you collected. Individual retirement accounts. And I'll have an assignment about these after this lecture, so remind me or I'll just give it to you anyway. An individual retirement account, also called an IRA. There's two kinds. There's a traditional IRA and a Roth IRA, and that's what the assignment's going to be based on. These are basically where you contribute to an account that the money has to stay in there for a certain period of time, basically 20 years until you retire. And once you retire, you can pull that money out. Now, certain IRAs have certain tax benefits, and we'll talk about that in class after the lecture. But the big thing you need to know is that these are the ones that basically have the fewest tax implications, and the benefit you get from them is a lower level of taxation, either before or as you're taking the money out later on. But you have to keep that money in there for decades, a long, long time. All right, loans. The biggest part of a bank is the loan industry. Their job is to take in money to then loan it back out at interest and make money off of it. That's what banks do. Now, the loans aren't given to just anybody. Like credit unions, you got to be a member of the credit union to get the loan from the credit union. And it's only going to be for things like a mortgage. You're not going to get a loan from State Employees Credit Union for a business. They're not interested in financing your business idea because that might fall flat and they lose their money. Now, private banks, they're much more inclined to do it, but they're probably going to make you back it up with like maybe mortgaging your house on that loan to make sure that they're covered. Approval and interest is based on a person's ability to repay the money, income, expenses, all in their financial history. If somebody has defaulted on 5 other loans, their interest is going to be super high, or the bank will just say, we're not loaning you this money. This is where credit scores start coming into play. You start seeing somebody wanting to get a loan and they have a credit score of 400, they're probably not going to get that loan because they have either a poor credit history or a non-existent credit history. High-risk applicants are charged a higher interest rate, or their loans will more often than not be denied right out. All right, so keeping our finances safe. There are regulations and there's books of them. They are long. There are entire fields of expertise related just to finance law. The one big thing we need to know about is the insurance system to keep our finances safe. The rules are strict, and the rules do change. After the 2008 housing crisis, the whole mortgage industry got turned up on its head because the 2008 financial crisis was linked directly to subprime mortgages and variable rate mortgages that were just a huge thing at the time. People lost their homes. It caused a major Great Recession that we're still kind of on our way out of as of 2016, 2017. So it was a big, big deal. It also changed how the FDIC works. Now, the FDIC is the Federal Deposit Insurance Company, and you'll see an FDIC sticker on pretty much every single financial institution you walk into, with the exception of most savings and loan banks, which don't really exist too much anymore. Now, before the financial crisis of 2008, personal accounts were insured up to $100,000. The problem was, after the financial collapse, a lot of accounts that had more than that in there because, as time goes on, money becomes inflated. And, think about how much a Coca-Cola cost in 1950 versus how much it costs now. That's inflation. So the value of money has gone down, which means we have more money in banks. And we had a lot of accounts that broke that $100,000 barrier that weren't insured, where banks lost everything and the banks collapsed and failed. So nowadays it's $250,000. So if you have anything below $250,000 in a bank in an individual deposit account, it's protected. And you can have more than one. There are people out there who have millions of dollars and they don't trust investments, or they're just at the point in their life where they're like, hey, I'm going to be spending this money. I'm not going to sit there and worry about investing it right now, who might have $2 million, and they'll just put the $2 million in 8 or 9 different accounts. That way they're each insured up to that $250,000. That way they can make it that if the bank fails, their money's protected. Now, the original reason for the FDIC was during the Great Depression, the run on the banks and the bank failures that happened. And I want to say the original amount that they were insured up to was like in the tens of thousands of dollars, very low, not terribly high. But that is basically the history of the FDIC. It was a outgrowth of the Great Depression and that first horrifying run on banks where the entire economy just collapsed and got destroyed worldwide, not just in the U.S.